Good day, everyone. My name is Konstantinos Sergakis. I have the honor to serve as the BPP OC Chair for the second year. A very warm welcome to all of you. This is our fourth annual forum. It's an open stakeholder forum purported to nurture dialogue between market participants, between issuers, regulators, investor organizations, asset owners, asset managers, and last but not least, service providers. Let me thank all the participants and all the panelists that we will have the pleasure and the honor to host today to our event. And of course, all the admin support that we have got from the University of Glasgow that has kindly co-hosted this event, from Glass Lewis and Minerva Analytics, who have also provided administrative support, and also, of course, to all service providers who keep on helping us every year in organizing this annual event. A few housekeeping matters. We will, of course, like to invite you, as we always do every year, to consult the BPPG website, where we have uploaded a few days ago our BPP OC annual report. There you can find the annual review results and many other information about the modus operandi of the BPOC, as well as the road ahead, things that we will be doing in the next reporting cycle for service providers. Today, we will have the first keynote from Jen Sisson, ICGN's CEO. Then we will have two panels, the first one with market actors and the FRC, and the second one with service providers themselves. Both panels will be moderated by our esteemed BPP OC members, Mike McCauley and Evan Epstein. And then we will have the pleasure to hear the second and last keynote of the day from Carmen Edinoia from OECD, before reaching the concluding remarks with myself. So I do not need to introduce again, of course, the BPOC and the BPPG. A very quick word to tell you that we are in charge of the monitored self-regulation program. We oversee service providers, the 5 current members of the Best Practice Principles Group. Our mission is to oversee this sector, to make sure that disclosure keeps on being improved. And as Anna Tilba, our esteemed BPPOC member and the chair of the review subcommittee, will be giving you later as information, disclosure keeps on improving. Things are getting much, much better, which again, of course, allows me to reiterate yet for another year the fact that monitored self-regulation may be not just a viable alternative to hard law interventionist measures, but maybe might be the optimal way forward, because it's an organic evolution towards best practices, continuous improvement of disclosure patterns, and allows for ongoing interaction and fruitful dialogue and education with service providers and their clients, but also stakeholders. So without further ado, I would like to pass the floor to our esteemed keynote speaker, Jen Sisson, CEO of ICGN. Jen, thank you so much for accepting our invitation. And I see that attendees keep on being added to the list, so we are still waiting for 60 people, more or less. But of course, a quick message to all of our attendees, even for those who cannot make it today. Of course, we are recording this forum and will be put on YouTube in a few days. And of course, we will send you the link. Jen, the floor is yours. Thank you so much again for being present today. Thank you.
Well, good afternoon, everybody, and thank you, Konstantinos, but very much for the invitation to speak to you all this afternoon. As you may know, ICGN is a membership body led by investors from all over the world, with around $77 trillion of assets under management. Our members are asset owners, like pension schemes and sovereign wealth funds, asset managers, and also various service providers and corporates who are involved in the governance and stewardship ecosystem. In fact, many proxy advisors, including members of the BPPG, are also ICGN members. Our purpose is to promote the highest standards of corporate governance and investor stewardship worldwide. Our members want to see the importance of governance be a stronger part of the discourse. And we are believers that G is absolutely key. It's fundamental to investment practices and to long-term corporate success. So we focused our work in 4 key corporate governance areas. First, strong and effective boards and board practices. Secondly, reliable financial and sustainability reporting, and assurance. Third, protecting shareholder rights. And last but definitely not least, best practices in investor stewardship. Now, proxy research and advice is a critical component of the corporate governance and stewardship ecosystem and touches each of those 4 key areas of focus. It's also, I think, a great example of how hard regulation isn't always the answer. In your roles as service providers to clients, a good accountability-based system reliant on checks and balances can work well. And in my view, the monitored self-regulatory model embodied by the BPPC is working well. And it's encouraging to see that governments around the world have largely supported it. It's complemented by stewardship codes that allow for service provider signatories and enable you all to clearly demonstrate how you help your clients execute their stewardship responsibilities. And they also ensure that your clients monitor you and make sure that your services are meeting their needs. So as we await the future and regulatory changes and proposals, we should keep this success in mind and be clear in our views to encourage the continuation of this model. As Konstantinos notes in the foreword to your 4th annual monitoring report, it's important to recognize both the value of the services that BPPG signatories provide to their clients, the providers of investment capital, and the respective roles and responsibilities of financial market participants in the process. It's a frustrating truth, though, that many parties continue to either misunderstand or willfully misrepresent the role of proxy advice and research providers. And this isn't just a threat to your self-regulatory model. This has been a key part of the pushback that has driven some of the changes made recently that lower governance and listing standards around the world. There's a narrative out there suggesting overreach by proxy research providers or a lack of active stewardship decision-making by investors that we all know isn't reflective of reality. Management teams, board directors too often cite votes being because XYZ provider told them to, rather than sitting with the more challenging truth that their investors did not support their proposals. This is not helping anyone. We've got to change this narrative, and we all need to work together to do this. We need to get back to basics and remember why corporate governance is important in the first place. Good governance is the foundation of business success. And investors and company management should all be on the same team here. We want the same things: long-term, sustainably successful companies that will drive good, long-term, sustainable returns for investors. You know, investors don't want to have to vote against management. Votes against aren't anybody's goal. Everyone's goal is about making sure that investee companies have good governance to support that long-term value creation. And no one thinks there's only one way to do good governance, but the fundamentals do tend to hold. So we need to have a thoughtful, balanced, and active approach to stewardship, and we need to consider issues carefully in the context of companies, market, and changing best practices. So high quality, well-resourced, thoughtful proxy voting research is a key tool to enable your investor clients to make those decisions. This kind of active, thoughtful stewardship in the long-term best interest of clients and beneficiaries is an important part of an investor's fiduciary duty. A part of that stewardship is about holding company boards to account to ensure they live up to their plans and create that long-term value. In order for investors to do that most effectively, they need strong shareholder rights. But we also all know that shareholder rights are under threat, and that has the potential to undermine the whole system as we know it. So we shouldn't take this lightly. This is a huge problem, and one that we all need to work together to address. Here in the UK, where I am, as well as across Europe, we're seeing countries seek to stem the flow of listings to the US by loosening their listing rules and governance rules, reducing voting rights, and allowing for the introduction of dual-class share structures. It's not clear that this will increase the number of listings, but it does introduce a lot of unnecessary risk into the system. The US environment is very heavily regulated and highly litigious, much more so than here in the UK or in Europe. So logically, that can't be the simple reason for choice of listing venue. Also, we've seen that the vast majority of companies listing in the US market so far this year did so under a single class share structure or with a sunset period. So that doesn't seem to be it either. ICGN will be working hard to advocate for the protection of shareholder rights. While we've been disappointed with the outcomes in the UK, we were really pleased to see positive moves from the Italian government in response to recent advocacy. You may also have seen that we recently wrote to the President of the European Commission to make some key recommendations for the EU. There's 6 of them. 1, remove obstacles to voting. 2, to harmonize AGM best practices. 3, harmonizing standards on shareholder proposals. Also, introducing safeguards against multi-class share structures. To ensure, number 5, to ensure that investors can rely on high quality corporate sustainability disclosures. And finally, to remove perceived obstacles to collaborative engagement. So this will form the basis of our advocacy work in the EU over the coming months and years, and I look forward to working together with many of you on this. Of course, you know, there can be well-governed companies in all kinds of markets, but the role of shareholders as active stewards to hold boards accountable for that governance will only grow as these lower standards create higher risks. And in turn, the importance of high quality, detailed, and thoughtful voting research will also grow. So I hope we can continue to work together to clarify roles and responsibilities of those across the investment chain, to be clear about why good governance is important, and work collaboratively to drive higher standards of governance in our investee companies around the world. So thank you all for listening today. I hope the rest of your event goes well. It looks like a great agenda. And I hope to see you all at an ICGN event very soon. Thanks, Konstantinos.
Thank you, Jen. Very, very insightful comments. And of course, on behalf of everybody, congratulations, of course, for this new leadership era at ICGN. I think that ICGN will experience even greater days under your leadership, and very pleased to hear also the engagement with the Italian government, but also with European institutions. These are very important times, and I think also geopolitically, market actors need to step up and set the tone, because we do experience a lot of misunderstandings, not just for service providers. And what the ICGN is doing, I think, is very, very important for all market actors in corporate governance. So thank you very much. I will kindly, and with your kind permission, move you now to the attendee list if you want to stay with us. Thank you again on behalf of the committee. And of course, I have the great pleasure. It's the moment we all wait patiently every year to hear from our esteemed BPP OC member, Professor Anna Tilba at Durham University, and of course, chair of the review subcommittee of the BPP OC. Anna every year is analyzing the outcome of the annual review of service providers' disclosure statements. And I see that Anna is already here with us. So Anna, welcome. We are patiently waiting for you to start with the results. If I could just sum it up, it all looks great. Monitored self-regulation has a clear rationale to keep on existing because we keep on seeing lots of improvements. But without further ado, the floor is yours. Thank you, Anna.
Thank you, Konstantinos, and hello. And welcome to our 4th stakeholder forum. As Konstantinos said, my name is Anna Tilba. I chair the review subcommittee. I've been with this initiative since the beginning of the first round. So I review the statements of compliance every year for 4 years now. So without further ado, it will be my pleasure to talk you a little bit through what we've gleaned from this year's reviewing process. So if you bear with me a little bit, I will share the slides. There's always slides. If you can see my slides. Yes.
Perfect.
And share them.
Excellent.
Yes.
Perfect. Thank you, Anna.
Just very briefly, I will provide a very quick overview of the submission this year and offer my general comments on reporting that we have to date, say a few words about methodology, and provide a very brief summary of the reporting. Obviously, a lot more information is included in our annual report, which Konstantinos and colleagues in the committee has been working very hard to prepare. So please, if you want to know more details, please go to the report itself. The reviewers, so obviously everybody submits the statements, and we're really grateful that the statements come in fast and a little bit later this year than in previous years. Here's the overview of the submission dates. Thank you for submitting, but obviously all these reports are publicly available on the BPP platform and also on each of the signatories' individual websites. These are the dates that we had the reviews, so we were able to produce the review on time for this forum and to include our review in the annual report. A few words about methodology. I've done really the same thing I do every year. I do a comparative analysis of all the review compliance statements. I communicate and prepare the draft letters, and we discuss them with the review subcommittee, which comprises of Konstantinos Sergakis, Mirta Bronzik, and also this year a new member, Fabio Bonimo, who's provided very valuable feedback on the drafts. So I look at obviously a comparative analysis. I prepare the analysis of the statements. I look at what's gone before, what kind of suggestions we've made. So it's an iterative process that involves going back and forth through what we've looked at and talked to with each individual signatory, and also highlighting the best practices and ways forward overall. So I produced the first drafts. I circulate them to the reviewing subcommittee. We discuss and revise them and approve. And well ahead of the Q3 meeting, which we usually use as a point of reference for the Oversight Committee to approve the letters, we discuss them as well, and the drafts then become final drafts where all the edits and suggestions are incorporated, and obviously then the letters are final and prepared. So this is an ongoing process. We are all learning how to communicate with each other. So one of the things that I did notice over the years, over the 4 years of reporting, is the improvement not only of the reporting itself. You will see here in the table that all signatories comply with all the principles of best practice, but also what I would also note is the improvement in the engagement. We developed different ways of communicating and engaging with signatories. Sometimes signatories providing separate detailed tables to us about how they responded to the comments of the committees on the previous statements. Sometimes signatories provide confidential response letters, confidentially separately outlining what they've done as in response to our feedback. Sometimes we have meetings where signatories seek to clarify some of the feedback we've given them, or adding new examples of changes they've made to the best practice. Some signatories have integrated reporting. I know only one is, if you're reading the annual statements, you pretty much know who I'm talking about. So we have a kind of a dialogue where we see where our comments have been addressed and what's being done as a result of this process, which I think is a very valuable, either publicly available record of how the self-monitored or regulation is working in action. And I think only sort of best praise to the signatories on engaging with us in this process. So very last slide I have, which I know we're getting close to the panel itself. So overall, I mean, I've been doing this for the 4th year. So I see broadly improving, as Konstantinos said, in reporting and all principles. And these are not just the singular examples. It's so many examples of improvement in best practice, but I only have 10 minutes. So I'm bound to focus on only very few. So for example, and not necessarily in this order of importance, one of the things we've noticed this year is improvement in Principle 1 reporting on quality assurance. We noted over the years that maybe signatories need to provide more information on how they fact check and track their errors. And obviously now we see and we note that with appreciation. I'm sure you've read that, signatories, a lot of that within the letters that we send you, that you do now provide more information on this. And of course, views on future directions, as we want to encourage you continue to do so. I remember in the first round, some signatories actually had a detailed discussions of what they consider to be major errors or minor errors, or having some snapshots of statistics of how many errors they track. So obviously we're really keen to see more of that disclosure, or continuous of that disclosure. Very easy identifiable improvement is when signatories disclose their diversity and staff qualifications. I remember in the first round of reviewing, maybe only one signatory, if not memory doesn't fail me, reported on gender diversity. Now all signatories report on gender diversity, but not only that, some started to also include other characteristics such as demographics or ethnicity or disability. So obviously it's a very visible progress in disclosure of information, as well as qualification as well. I also note outside of this table that the timeliness of delivering reports also improved. And this is obviously a good thing, that the companies have more time to digest the reports themselves. Last year, we also suggested, in order to improve sort of the perception of the market in terms of how signatories address the geographical and legal context, to include a bit more information on ESG methodologies. And this year, the reports, everybody has done that, and I think it's a very important step in understanding how the quality, how the methodology works, and what on which basis signatories provide ESG frameworks and recommendations in that area. We also noted that there's been improvement. We've communicated our preference that the signatories signpost to a 3-step approach to addressing or escalating complaints, raising from, in the first instance, raising complaints with the signatories, and then maybe raising it with the BPG group, and then ultimately with the OC. So now we see and would like to encourage the signatories to continue to do that. I've already mentioned the future directions for further disclosures, continue with errors trackings and everything, obviously what you've already been doing. I know that revenue sources is always a sensitive issue, so we flag this up regularly, but we do understand that some of this information might not be appropriate to disclose in public. We would also like to encourage our signatories to continue to report or mention the impact of best principles themselves. As we say, that this exercise is beneficial for the raising standards of governance, but also market perception and confidence in the governance practices of signatories. So engaging with the best practice principles and this process, and highlighting how and what has changed as a result of this is obviously, we believe, to be beneficial. And I think it's always important to keep the Oversight Committee communication channel on the radar, because we try to do our best for this process. And so we're always open to communication and dialogue with the signatories and other stakeholders. And I think I've just about covered all I wanted to say at this point, but obviously a lot of this information or further information is available in our annual report. So I will head back to Konstantinos, and thank you very much, everybody. Thank you.
Thank you very much, Anna. Of course, I knew the results a little bit already, and we did release the annual report a few days ago, as you correctly mentioned, but it's always very nice to have this kind of synthesis and summing everything up in 10 minutes. So thanks so much for keeping the time. But I guess that, we can safely, again, repeat as BPOC this year that we are fairly satisfied with the ongoing results. Disclosure keeps on improving, as you rightly pointed out, but we are definitely truly satisfied with the level of engagement of service providers. We keep on increasing engagement sessions. They keep on asking questions. We keep on asking questions. It's again how we can actually make the monitored self-regulation model work properly. So it's an ongoing process. We never said that it would be easy. No one pretended that it would be easy, but we have a very constructive dialogue, and maybe that also explains the fact that we have continuous improvement in the disclosure statement. So a very positive assessment overall. Thank you so much for your presentation. I am moving you now to the attendee group. Thank you, Anna. So I think we can now start bringing on stage our esteemed panelists for the first panel. So the first panel, as I mentioned before, is related to the market views on the best practice principles, but also it's not just market actors participating in it, it's also the FRC. We have the great pleasure of having Maureen Beresford, Acting Director of Corporate Governance and Stewardship at the Financial Reporting Council, being being one of the panelists. So Maureen, welcome to our event. Then, of course, we have Peggy Foran, Chief Governance Officer, Senior Vice President and Corporate Secretary of Prudential Financial, who will be also joining us in, hello, Maureen, in a second. Peggy, I can see you, and perfect, excellent. Welcome, Peggy. Patti Gazda, Corporate Governance Officer, Ohio Public Employees Retirement System, is another esteemed panelist. And Patti, you will be moved to a panelist in a second. Perfect. Aude Rodriguez, Head of Investor Relations at Air Liquide. Welcome, Aude, as well. And Kyle Seeley, Head of Stewardship, New York State Common Retirement Fund. Welcome, Kyle, as well, and thank you for your participation. And of course, last but not least, Edouard Dubois, Head of Proxy Voting at Amundi. And welcome as well, Edouard. Thank you for your presence today. And as I mentioned at the beginning of the event, the panel will be moderated by Mike McCauley, our esteemed BPP OC member, who is also, of course, Senior Officer at Florida State Board of Administration. Welcome, Mike, and thank you for your ongoing effort. Mike, of course, is as well a member of the Forum Subcommittee, so I have to particularly thank him for helping enormously with the current program of the BPP OC Forum, as he does every year. So a big thanks to Mike for moderating this session. Mike, the floor is yours. Thank you.
All right. Well, welcome. Thank you, Konstantinos. Welcome everyone online to the panel one of the forum. As Konstantinos said, I'm Mike McCauley. I'm Senior Officer with the Florida State Board of Administration, the Florida SBA. And the first panel will really cover market views on the best practice principles. We'll hear from a number of global asset owners and managers, a corporate issuer, and as Konstantinos noted, one regulator, the FRC. So we'll discuss their experience using the services of proxy advisors and issues tied to research delivery, general practice, disclosure. Well, I think we'll cover the waterfront. I'll moderate the discussion and let each panelist provide a little bit more detail on their role at their organization if they want to do so. Konstantinos has already introduced each panelist and the organization that they're with, and then I'll go through a series of questions. We should have some time at the end for a short Q&A, about 10 minutes at the very end. Get panelists to comment further on questions posed by either forum participants or some of the comments inter-panel. So if there's some intriguing commentary and dialogue, we can get a nice discussion going. So with that, let's jump right in. We'll start the discussion, and I think we'll just follow the course of the agenda. So kind of arbitrary, but we'll just start out from a regulatory perspective and hear from Maureen. So the first question for you, Maureen, would be, as a regulator coming from that perspective, do you think proxy advisors have too much influence over market participants? Which ones, perhaps companies? That's I think a typical criticism, kind of their impact or their power, if you will. And if you do think that, why? If so, why, and or why not? And really kind of tied to that, how does the BPPG Oversight Committee, the annual report, the disclosure analysis, et cetera, how does that impact your work as a regulator?
Great. Hi, Mike, and thanks for inviting me to speak today. It's a great opportunity. So just to give you a little bit of background, I'm from the Financial Reporting Council. We're responsible for the UK Corporate Governance Code and the UK Stewardship Code, both setting high standards of transparency. And I was listening to Jen Sisson's introductory remarks, and I think I might cover some of the same ground, answering your multiple questions that you've asked me, and I'll try and do it in 5 minutes. Yeah, I think I'd like to start by saying I think a principles-based approach is a great approach. It offers that flexibility. It offers everybody who's reporting the opportunity to get into the detail of what they're doing, to think about what's important to them, what's important to their stakeholders, and provide decision useful information, whether that you be an investor, a proxy advisor, service provider, or an issuer. So picking up on what Jen said again, really supportive of that non-regulatory approach, even though we are a regulator, but we do offer that approach to these codes. Do proxy advisors have too much influence? I think that probably depends on who you speak to, but I'm really struck by talking to issuers. And again, linking back to what was said at the beginning of this session, there is this general view from many issuers that proxies have significant influence and often seem to stop creativity, stop companies achieving what they want to do, and not offering flexibility. And I think Jen used willfulness. She said that companies are sometimes willful in thinking that it's the proxies and not the investor. And let's all remember that the proxies are actually providing a service to those providers of capital. So there are lots of actors in this. There are many actors other than just a proxy advisor. So I think it's really important that we think about this in the round and think about everybody's own position and what they're doing in this piece. So I think what the work of the BPC is doing here is really, really useful. They're getting information out on they're raising standards, and they're trying to promote good quality reporting, good quality information, etc. And it's quite disappointing that when I often talk to stakeholders that the BPPG is not that well known. And I think there's a real opportunity on the back of what's happening here, the report being issued and the reports of the individual proxy advisors, to offer that additional transparency to all those stakeholders that maybe think that proxies have undue influence, but to find out what they're doing in terms of engagement, quality assurance, improved timeliness. All these things are picked up in the report that's been issued today and what the Oversight Committee has thought about. And I think if we can capture that and bring the three main actors together to work together, that's got to be good, and it's got to be good for the markets.
Okay, thank you. Some interesting comments. So we'll switch a little bit, get a different perspective from an asset manager. So we have Peggy Foran with us this morning. So Peggy, what are your views on how clients and maybe the BPPG approach and kind of what it does? How can clients analyze and manage proxy advisors' conflicts? Many of them have conflicts of interest, or at least potentially do. They sell additional services, consulting, and data. What are your perspectives on some of the business lines, if you will, for proxy advisors?
Thank you, Mike, and I'm so pleased to be here. And I've been on this panel for 10 minutes now, and I've already learned so much. So I really appreciate it. But as an issuer, and I guess my company is an asset manager, as also a public board member, there are stories that I hear, particularly in the issuer and director community, about the proxy advisors and their conflicts. I have to say that in all the years that I've been doing this, I've never seen a conflict. I think the proxy advisors and the work that you're doing it should really be assuring people that there really is a wall. And I certainly have seen that. What the proxy advisors are doing, if they are providing services such as advice, they're giving you advice. You don't have to take that advice. Just like, for example, their recommendations, as Maureen was saying, that's advice to institutional investors. You don't have to take it. It's a point of view. And it's, in many instances, it's a good point of view because of the time and effort and, work that's been put into it. So I think it's really the same thing about the conflicts. The proxy advisors have their own internal systems that provide for that. And I know as an issuer that has from time to time purchased services, they make it very, very clear that one is not contingent on the other. In fact, you're really not allowed to tell either side, what the other side said, or that you are purchasing advice. So I think it's been handled very well. I think your work and the work of the group has also been a help, but nevertheless, we all need a victim. If you buy services and you don't get what you think you should get, or if you get a negative view, it's always easy to blame a proxy advisor. I still see some of that blame, not as much. I would say 20 years ago, it was much more frequent. But I think maybe because of improvements and transparency, the thought that there are conflicts that are being utilized, less likely to hear that.
Okay, all right. Thank you, Peggy. Let's get the views from an asset owner. So somewhat related to the asset management side, but a little different and more of a retirement orientation. So Patti, from your perspective as an institutional investor, as an asset owner, what has been your experience using proxy firms, and has the BPPG, it's a mouthful, been useful to you, and if so, how?
Okay, thank you. Yes, as an institutional investor and asset owner, we have in the past, and we continue to partner with proxy firms for research and the vote platform. Our corporate governance program was created about 30 years ago, and a lot has changed since then. But one thing that's remained the same is our consistent focus on good governance and our belief that that's the way to maximize the value of the investments we make with our retirees' contributions. So just to answer your question a little bit about how our retirement system is set up, we have both internal and external investment managers, but corporate governance is outside of the investment world here. And with limited resources, we vote about 10,000 meetings a year. So I'm sure you can appreciate that that can only be done, you know, partnering with a vendor to get timely, independent, and accurate information. So, you know, one of the things that has emerged is this, the proxy firms have come under fire and scrutiny the last several years. Some of it goes from lack of competition to robo-voting, or, you know, the claims that some institutional investors are just abdicating their responsibilities to proxy firms altogether. And some of that is free market, right? I mean, they all have multiple offerings of research and policies, and, you know, you pay for what aligns with your program. You know, our experience hasn't been that they're influencing our votes. We have a custom policy, and although that is based off of a benchmark policy, it's our own. And our experience with proxy firms has been largely very positive. Back in 2018, we actually participated on the SEC's roundtable on the proxy voting process, and you know, we talked about that and shared that information. One of the things that was a result of that came about was that at least the two proxy firms that I have experience with created this issuer feedback mechanism, so that, you know, when there was an issuer who felt as though information was inaccurate, you know, it was pushed out to the proxy firm clients in the issuer's words, no, you know, no change. And it was done pretty timely. And I know we have issuers on the panel, so it would be interesting to hear their experience if they've used it and what they believe that. But speaking for myself, it's been positive, it's worked, it's timely. So communication has worked well for me, the immediate notification. A big change that's come and is impacting us, a lot of states, Ohio being one of them, is legislation being introduced to make certain investing, and in the case of Ohio, proxy voting, to make certain that that's done only with pecuniary interest in mind, not for the purpose of any social, moral, or environmental agenda. And again, speaking as a representative from a mature system, I can tell you our focus has to be on creating those returns so we can continue to pay benefits. It's hard when you go and talk to these legislators who don't work in this realm to get them to understand how proxy voting, how corporate governance works. So that's one area where the best practices principles and the oversight committee has been helpful, that, you know, the service quality, the conflicts of interest and communication, you know, you can talk about that. You can tell them, point them to the reports, whatnot. Is it going to sway their mind? Maybe not, but at the end of the day, the reports are transparent and they're factual. You know, you can't get away from that. In the future, how can, you know, how can it continue to be helpful? One thing I want to mention also is that, you know, we have more than the big two that are represented here. There are 5 right now, and the more signatories we can get, the better, right? Because that's one of the big issues as well, is that there's no competition. Well, there is, and again, it's a free market. We put out a, you know, bid for the services that we need. The other thing that I do is I have stopped referring to it as a proxy advisory firm. I talk about proxy firms, and we use research. I'm trying to do what's in my wheelhouse, you know, to quell the thought process that there's this undue influence. So in the future, things that, you know, will continue to be helpful are to make sure that as trends emerge, like AI, other things, those continue to be incorporated so that, you know, we have something that we can put in hands of individuals to try and educate them to do the best that we can. But so that's my experience using proxy firms. the BPP and the Oversight Committee has been very important, very helpful. And unless something changes structurally here at the retirement system, I need proxy firms to be able to continue to do what they do, to give us the research that they do. And I see the BPP signatories and the Oversight Committee as being an important part of that.
Okay, thank you. That's really good comments. I would underscore. We've had a similar experience, and I would agree with you wholeheartedly. So we will now hear from an issuer. We have Aude Rodriguez. So Aude, you know, given your experience, have you seen improvements in your relationships with proxy advisors, deterioration over the past few years? You know, how has it changed? And can you share, you know, any further, if there are improvements or concerns that are going on today, or that you might even, you know, if you could see around the corner, if you might speculate on what they could be given market developments? So just kind of describe your experience with proxy advisors or research providers, whatever term we use.
Well, thank you very much, Mike, for this opportunity. So I've been in my job for close to 10 years now. So I'm happy to share my experience. So yes, what I've seen is a strong improvement in recent years in terms of engagement and dialogue with proxy advisors. So it's more transparency. It's annual dialogue that is now in place through annual roadshow with shareholders and with proxy advisors. We can also review the report from the leading proxy advisor before it is issued. So all this, I would say, is working relatively well today. And it is definitely much, much better than 5 to 10 years ago. We have also recently observed a new trend over the last few years. It's the growing emphasis on ESG topics during our governance meetings with investors. And I believe it's often because the same teams manage both areas. And occasionally during the year, we can engage also with our governance contacts on ESG topics, ESG matters, but this is not yet a common practice. So significant improvement all these recent years and more ESG discussion. However, I have identified 2 areas of improvement relative to the best practice principles. So the first one is that we firmly believe that companies should not be charged for reports evaluating their own governance practices. And the current cost today is €5,000. Second is, and that's what Maureen mentioned, is market concentration. And I confirm that proxy advisors have a high influence over issuers. So the proxy advisor market, as you of course all know, is highly concentrated, and it gives a significant influence to the market leader. And I can tell you that issuers today effectively need to have positive recommendation from this proxy leader to secure sufficient votes on resolution. At Air Liquide, I can say that at least it represents 60% of our shareholder base that is influenced by the proxy leader. So therefore, a negative recommendation for us is really a nightmare. So this concentration of power really creates an unbalanced dynamic. But to finish with, the point I wanted to raise today is a bit different, and for us it's a major concern. Indeed, at the AGM this year, before the AGM, we met investors and we understood that they were referencing ESG reports from the same proxy advisor that issues voting recommendations. But these ESG reports, to our dismay, contained voting recommendations that contradicted the proxy voting guidance. So this ESG report is not managed by the governance research team, and we haven't been able yet to engage with the author of the report. So for us, well, I consider it does not follow the BPG best practice, and we hope this point can be addressed soon. So thank you very much.
All right, thank you, Aude. Just kind of a follow-up question to that. Have you noticed any changes? And again, just from your perspective, have you noticed any changes when there is disagreement or there's some question about the analysis or the ultimate recommendation that a proxy advisor will make? In terms of the dialogue and the feedback, have you found that proxy advisors have become more, sensitive or receptive to the feedback that at least from your company's perspective has given, or has it been about the same, or has it deteriorated? Just curious.
I would say, yeah, there are two steps. We have two opportunities, I would say, to engage and discuss and get the feedback from proxy advisor. So for us, the governance roadshow is really key. We organize it at the end of the year, so several months before the AGM. And here it's an opportunity really to engage the discussion and understand each other. So that's the first step. And second step, yes, especially with one proxy advisor, we can make comments, and our comments, the most important ones, are reported in the proxy report. So I think this works pretty well. And I think, yes, it's more and more open. There is more and more engagement and discussion than it was, let's say, 5 years ago.
And Mike, as another issuer, I can assure you, the proxy advisors that I reach out for, because we do a significant amount of engagement with our investors as well as our proxy advisors. And they have always given us their time, always. And, when we had a particular issue, we actually called in advance. They gave us time. They actually gave us advice. And then once the proxy was out. So yes, I think it's much easier. Not only is it easier for large issuers like myself, being on boards of smaller companies, again, if you know how to get in touch with them and ask, we have had no problem speaking with them. So, I think it has significantly improved, and they're willing to give time and advice free if you can.
Gotcha. Okay, interesting. Thank you, Peggy and Aude. Okay, so we'll talk to another asset owner, Kyle, and this is kind of switching gears completely. Artificial intelligence and kind of technologies are quickly emerging and evolving, rapidly. So I would like to get your views, like how might an AI function impact either the oversight of proxy advisors or even the quality of the underlying proxy research? And you can answer it, from a number of perspectives, but maybe from that institutional investment perspective. Yeah. And then how could it impact the BPPG model itself?
Thanks, Mike. Just background, Kyle Seeley with the New York State Common Retirement Fund. I lead our stewardship operations, which includes oversight over our proxy voting program. We vote all our proxies independently based on our guidelines, but we do utilize proxy advisors, the research, as well as the voting platforms to do our voting. And that's an extremely important tool for us to be able to vote. We think voting is an important means of us being able to exercise the controller's fiduciary duty, as well as communicate to companies our expectations on a host of corporate governance related issues. So it's an important part of our investment process. And we, as I mentioned, we subscribe to multiple proxy advisors research, and we are always making sure that we're getting correct and accurate information. That's our biggest, in a timely manner. That's the most important part to us. And as we're seeing the growth in AI, we continue to engage with our proxy advisor firms that we contract with to understand how they are interacting with this new technology. How are they using it to improve research, to protect from any errors, but also, you know, is there any enhancements that can happen? I think we're all aware that proxy voting firms, it's a resource intensive operation. There's probably AI can probably assist in some of those operations to both find efficiencies, but also improve the findings and reports. But it needs to be done in a way that it's providing correct and accurate information to the investors that rely on it. And I think you're not going to see this go away. It's only going to become a more important issue. And, you know, not just from the perspective, is it correct information, but are proxy advisors relying too heavily on telling clients, we're using all this AI and we're making sure that's all correct? Is making sure there's not an AI washing type of thing happening where they're saying, oh, don't worry, this is all happening, without explaining how it's being used and how the oversight's being provided. So, you know, it's an emerging issue, and I think it's definitely something that the oversight committee can maybe look at, and how AI is playing a part of their operations, making sure that we're getting that correct, accurate information.
Yeah, interesting. I think you coined a new term. Maybe I haven't heard that, AI washing, before. We'll see how it plays out. Okay, so last but not least, we have Edouard Dubois, providing an asset manager perspective, again, similar to Peggy's. So Edouard, as a client of Proxy Research, you know, what do you feel the benefits that you're at least perceiving that you're getting when a proxy advisor signs up to the BPPG? And related to that, what is your, you know, kind of overall or general view regarding the self-regulatory approach that it represents? So what are your comments on that?
Thanks, Mike. So Amundi is a large global asset manager. We manage over 2 trillion of assets and voting over 10,000 meetings every year. So of course we need proxy advisors. So we contract actually with multiple proxy advisors to get independent proxy research, voting recommendation, and electronic voting services. We use 3 advisors to really receive the different point of views. And we also get actually custom recommendations based on Amundi's voting policy. So we really make sure that all our voting decisions are based on Amundi's policy. Obviously, getting timely, reliable research is vital for us to make this informed voting decision on behalf of our clients. And as with any other providers, we conduct due diligence and we continuously monitor their services. We engage regularly with them. We reply to their survey. We provide feedbacks. And as a client, we really need to have this transparency on their processes, on their methodology, on their staff competencies and trainings, and how they manage their conflict of interest. We really believe that we need to create this level of trust in the market that the proxy process is working efficiently and that investors are well managing their duties to vote on behalf of their client. And so in that regard, the BPP and the monitoring done by the Oversight Committee is really helpful to really build that level of confidence in the market around the proxy voting process. I believe that one of the most positive elements of this process is that really creates a virtuous circle, because we see that year after year, the proxy advisors are improving their practices. They are more transparent. We see the compliance statements are getting longer year after year, which is really, I think, a good sign, because they are improving their practices based on the comments received by the Oversight Committee, but they are also learning from the best practices of their peers. So this is really a continuous process of improvements that I believe needs to be applauded, and which does show that private ordering can work. And so there is always this question, should we favor hard law versus soft law? And I think it's not a matter of either or. We probably need a mix of both. Proxy advisors are an important actor in the stewardship ecosystem, so some degree of regulation, even hard regulation, is to be expected like for any other player. Hard law is sometimes necessary to really draw the lines to have a clear framework. That being said, in the stewardship world, there is really value in having this mixed approach. We have codes of governance, we have codes of stewardship, and so we know that private ordering can be useful in a field which is very evolutive, because we know that hard law can take time. ESMA also was very clear that they did not see any market failure. As a client, we don't see a market failure either. So in that case, we don't really see the need for more hard regulation. We also have to keep in mind that anytime that we add this new regulation, we also increase compliance costs. We know that we already do not have enough proxy advisors in this market. And so it could be dangerous to raise even higher the barriers to entry into the market. So it's something that we believe the regulators should really keep in mind here.
Okay, interesting. And those comments are kind of a good segue. We've started to receive some questions from the audience. And one of the questions, I think is really related to your comments just a few moments ago. And it might be one that's perhaps interesting from Maureen's perspective. The FRC consultation on the stewardship code identified proxy advisors as one of the key themes, and that they'll carefully consider how the code might support greater transparency on their activities. So from an investor perspective, a regulatory perspective on investors, what in terms of a stewardship code point of view, Maureen, would you have any more commentary on what this will consider, what the FRC will consider, and how it relates to the BPPG itself?
So obviously we're not actually consulting at the moment. We will be doing before Christmas. So I can't tell you what's in the consultation, but we are on record as saying that we will be looking closely at proxy advisors. But I think this goes back to the transparency point that I talked about before, and the transparency issue that the BPPG are trying to promote. What we want to see is that transparency in approach, that transparency dealing with policies from proxies, etc., how they engage. So that's the issues that we're looking at, to see whether those proxy agencies that are signatories to our stewardship code could offer additional transparency when responding and applying to be a signatory. In terms of how that will relate to the BPPG, there may be some overlap, but there may be some complementary requirements for our stewardship code. And I think that also goes back to the point that I made in terms of the profile of the BPPG, and we would like that clearly to be raised. But equally, if there is some overlap between the UK Stewardship Code and the BPPG, that's another way of raising that level of transparency as well. So even if there were some elements of duplication, then we think that's good duplication to maybe raise that transparency for those issuers to fully understand and have comfort in the approach that the proxy advisors are taking, and enter into dialogue with them. So I can't tell you what's going to be in our consultation, unfortunately. It will be out soon. And I'll confirm, we are looking at some changes there.
Okay. Well, I just have to wait. Stay tuned. All right. Well, we still have some time left, and we have several questions in the queue, but I'll go back to just a general question and this, anyone can respond to this. Any of the panelists, what would you say are really some of the toughest, maybe if you had to pick one thing, the toughest challenge facing proxy advisors globally, what would it be? And that can be kind of a constructive criticism comment or something they're doing, well, but will continue to be challenged by it. And it can be A to Z. But like if you had to name one thing that is a headwind, perhaps from proxy advisors, if anybody wants to tackle that.
Yeah, Mike, I had mentioned it in our meeting before this call, but I'm very concerned with the consolidation of proxy advisors. And I suspect they have incredibly thin margins, as folks that are receiving the advice in order to make our decisions, we're constantly, as we should, trying to negotiate it down. And I'm just not sure at the end of the day if this is, who's going to be left. So, I mean, that's always been a concern of mine. I think if you look 10, 20 years before, I think you saw there's a lot of barriers to entry. I guess that's what I'm
right.
saying. So that's what I'm concerned about.
Okay, that's a very good point.
I think that the continued focus and thought of the influence that they exert is something that's going to continue, and how to combat that, I'm not entirely certain. But I think that that's something definitely to watch for. And then as Kyle brought up, the impact of AI, and even, the retirement system, we're just in the process of creating a policy ourselves for AI and how we can use it, what's acceptable. And I think that, as this continues to evolve, we're going to see different things come up, even in terms of, are we able to consider vendors that rely heavily on AI and that whole process. So I think it's something definitely to keep an eye on as well. That's going to be a challenge.
That is a very good point.
Any Mike, I would just
comment?
I would just jump in and say, it might not be the number one issue, but it's probably close up to the top, is that regulatory scrutiny is not going away. Whether that's in the US or globally, it's only going to increase. And that's why this and the work being done here is extremely important, because sometimes scrutiny can improve practices, can improve what their business model. And I think that's what's going on here, and being able to communicate that when a regulator comes knocking on the door asking questions is very helpful. So I don't think that scrutiny is going away, but this is the type of work that can help possibly address some of the concerns down the line.
And Kyle, I absolutely agree, and I also think it affects perceptions, which, again, the reality may be it's fine now, but to the extent that people perceive that it's transparent and fair, I think is very important.
And we've gotten one question that I think it's aimed at Patti, but it's really for the whole panel. I'd be interested to get your views on it. It's kind of related to what we were just talking about, but it's, kind of the notion of fiduciary duty as an institutional investor. What does that mean vis-a-vis proxy research? How close do you, hew to the, whether it's the benchmark policy or other policy frameworks that have developed? And we've seen that evolve, especially in the US, but I think globally. So I don't know if anyone has any thoughts, Patti or otherwise, on, you mentioned the pecuniary factors. A lot of US states have adopted that statutory language, legal construct from a fiduciary perspective. And we've seen the evolution of whether it's pass-through voting, more voluminous or optionality with respect to some of the bench policy frameworks from at least some of the larger signatories. How have some of the institutional investors perhaps adopted that or not adopted it? What are your views, and asset owners or even the issuers? If anybody wants to tackle that.
I'm going to make sure I understand the question entirely. To what extent are proxy advisors able to factor that into their research and vote recommendations?
More or less, like from a fiduciary perspective, how do you ensure you're taking a voting position that is sound? from a fiduciary point of view, and it's not,
Yeah,
just
that's
a normative policy, let's say.
yes.
Right.
Yes. It's hard to measure, right? Because and believe me, I have struggled with this. I've been asked this question before. How do you know that what you're doing is actually having the intended impact when you can't entirely measure it in isolation? And the way that I have to answer that is, we look at our proxies as plan assets, and we believe as a fiduciary we should vote them all. And we're concentrating on the G, the governance. We base that on best practices, research, our experience. At the end of the day, those are the things that we have to go on. I don't know if Kyle or anybody else has anything else to add to that. I mean, it's tough because it's one of those things that's not entirely measurable. Easily measured, I should say.
Easy, yeah.
Yeah, for us, when we adopt our proxy voting guidelines every 2 years, when we do an update, we're reviewing each one of the principles in those guidelines to ensure that do we believe that what the definition of an independent board is, does that align with what we think is in the best interest of our fund? So when and our investment in a company. So we look at each one of those principles to make sure, does that still align with what we think is going to make money for our company, or is in the best interest for oversight? So in terms of implementing, thinking about fiduciary duty, we rely heavily on our guidelines. Our guidelines effectuate what we believe is in the best interest of our investment and will improve our investment. So that's how we do it, and we don't really rely on benchmarks or other proxy voting policies, but it's our guidelines.
Maybe if I can just add, I think
Absolutely.
it's going back to the principles, which is, do you believe that governance matters? And we do. We do believe that well-governed companies will be more resilient, in a better position to oversee the risks and the opportunities. And that's why we are voting, defending this principle, defending the right of minority shareholders, because we do believe that's the best way to protect the interest of our clients. And so that's in line with our fiduciary duty.
Well said. Well said. And kind of along those lines, one of the questions in the queue is, I'm not sure exactly what they mean. I think I know, but kind of this notion of vote washing, where, whether it's similar to greenwashing and kind of the ESG dimension, but do asset managers try to, put on a good, wrapper around their stewardship practices when they may not have, at least again, from a perception or a client's perspective, done everything they could do from a stewardship perspective. So it's just kind of the idea of vote washing, or kind of the optics, like Peggy noted. I don't know if anybody has any comment on that.
I've seen some of that. Generally, it may be the mid to smaller institutional investors that really, don't have a staff. Larger ones, state pension funds, spend a significant amount of time, but they have very little. And what they may do is they may send a letter to the issuer, essentially saying that they voted against them, and they consider that engagement. As an issuer that really tries to engage with a lot of our investors, certainly over a majority, we recognize that it's easy to engage, with the larger ones, or even some of the top medium ones. Smaller ones, it's hard. And if they are signing certificates that they really are, involved in stewardship, I think a few of them, I'm not saying it's widespread, I think it's more check the box for them.
Okay.
Maybe what we can say is that we clearly see an improvement. I mean, if we look at the last 20 years, we see that stewardship teams, voting teams have been growing. Investors are more transparent. I mean, voting policies are published, voting records are online. So it's going into the right direction. and we see more and more dialogue, and most proxy advisor clients now use custom policies. I mean, they do not just follow blindly benchmark recommendations. So that's not perfect, but we are getting there, hopefully.
Okay. If you focus on more of maybe the European perspective, or at least the European markets from a regulatory point of view, do any of the panelists have views or comments on how kind of the demand for ESG reporting and related reporting, just in those E, S, and G categories, could that put a strain on the ability of proxy advisors to, analyze information, the quality of the research? I mean, is there any kind of strain or kind of overload the system going on with respect to the regulatory frameworks? I don't know if Aude or Edouard or Maureen, you have any views on that? Not a problem.
I
Okay.
think there are a lot of different organizations in this space at the minute, and lots of people providing different quality of recommendations. There are standards are missing in Europe. There are some standards that are known, some are kind of being worked up at the minute. We don't have a harmonized approach yet, and I think once we get to that will help us a little bit to try to understand what the metrics are that we should be looking at, what the objectives are that we should be looking at. So I think time will tell. I think there are a lot of people in this space offering advice and offering recommendations, and I think these need to be taken and understood in terms of what the investors are trying to achieve. So think about what their actual objectives are, what they want to see in the longer term, why they want to do that, and not treat it as a tick box approach that they just want to see improvements in climate, improvements in nature, improvements in whatever. Try and see that as an objective that will improve the return for your beneficiaries, and why it's important, and when and how the providers of capital can actually determine who to put that capital with based on those policies. So I think there's a lot of work to do in Europe on this at the minute, and I think we're still in a period of working out how to get there and what metrics and what standards are useful, but it's a project and it's a long-term one.
Okay, thank you. We've got a few minutes left. There's another question that touches on I think a perennial issue, is the timing of disclosure of information and how perhaps proxy advisors, different firms, are treated in that engagement. This is more maybe from an issuer perspective, so Aude or Peggy even can comment on that. But what's the experience been with engaging in multiple proxy advisors at the same time, ensuring that you have, kind of in the US, kind of, Reg FD and some other regulations that you're required, the timing of the disclosure and the reporting has to be, full and consistently applied. And how does that weigh in with a company's interactions with a proxy advisor? If there are any concerns, maybe there aren't.
Yeah, except for things like mergers, maybe acquisitions. This really hasn't been an issue. Again, I would say the vast majority of things that we talk to our proxy advisors about are not material, non-public information. They may be process, they may be strategy, they may be changing a comp plan, but I wouldn't consider it material. So, so I think you can tick off just a few things that, from that perspective that you would have to be concerned about.
Yeah. Aude, did you have?
Yes, maybe on our side, in fact, during the proxy season, what we see, so 1 month before our AGM, the proxy advisors are not available. So it's not the right timing to engage and discuss about the resolutions. So that's why we organize a roadshow a few months earlier to take the time and have their availability to discuss the topics. And when the report is issued for one proxy, we have 24 hours to review the report. And what we've been doing these past few years is that, well, we try to issue all the documents as soon as possible. And then we have a contact with a proxy advisor, and we try to give our own availability, or when we have a major event, try to have them avoid the date of issuance of the report. So it's working relatively well.
Okay.
Can I just,
Good. Yeah, go ahead.
Yeah,
Go ahead,
could
Maureen.
I just add to that? I think it's really important to remember that engagement throughout the year that Aude suggested is really, really important. We've heard today that many investors have bespoke policies which their proxy advisors are using, but if you're talking directly to your investors on things that may come up at the AGM earlier than that time, then that is going to help you get your votes organised. It is difficult in proxy season, and most things, you know, the votes will be with management, but if you know that there's going to be an issue, that dialogue throughout the year is really important.
Okay. And that kind of made me think of some of the proxy advisors do, you know, policy outreach to clients regularly, you know, at least annually or more frequently on a ad hoc basis. What it'd be interesting to get the views of perhaps some of the institutional investors. Do you feel that that is useful, or it kind of games the policy framework, if you will? It's, you know, it's kind of circular logic if you're providing feedback that is maybe aligned with your own policy framework and a proxy advisor adopts that, as opposed to not adopting it. Does that affect you know, the market in any way, or should proxy advisors be doing anything differently? It's just kind of a potential impact. I don't know if Kyle or Patti or Peggy, you have any views on that? Like, how useful is that effort on the part of some of the advisors that do it? No thoughts? All right. Well, I just wanted to give a few minutes at the very end to, if any of the panelists wanted to, you know, underscore any points or even react to some of the other comments made by others on the panel. Any closing comments? Just give you a few minutes if anybody has any.
You know, it's been said, and I want to underscore it. There's been incredible progress. I think there's a lot more trust. There's certainly a lot more transparency. There's a lot more availability to talk and to walk through things. So I applaud all of you who have spent that time making sure that the system every year is improving. So thank you.
I think it has definitely improved significantly over the last few years, from my perspective. Any other last closing thoughts? Otherwise, we will get back to balance of the time. Go ahead, Maureen.
I would just say there's so much information out there, either from proxies or for investors. And I think just taking time to understand that and read that would help in the relationships between all the actors. And I think it's really important to promote what the PPPG does and what anybody on this panel does in terms of offering additional transparency to what they're doing to help the ecosystem and voting and relationships between all those there in the system.
Okay. Yeah. Well said. Well, I want to thank all the panelists for an engageful panel discussion, and I'll give the floor back over to Konstantinos for the next panel.
Thanks, Mike, and thanks again to our panelists. Thank you very much. I will move them now gradually to the attendees if they want to stay a little bit longer with us today. No obligation whatsoever. And of course, I will, I think we can get a comfort break 3-4 minutes, waiting for the panel 2 members to come on stage. So a comfort break for everyone, 2 or 3 minutes, and we'll be back with you. Thank you.
I thought I better blur my background because it's a mess.
Thank you, Sarah, and welcome. Okay, I think we're good to go. I would kindly ask the panelists and the moderator to turn on their cams as I'm presenting them. I have the great pleasure to introduce to our audience panel 2. It's service provider views on the best practice principles. So we have the great pleasure to have together with us today Richard Adeniji-Jones, engagement manager at EOS at Federated Hermes Limited. Welcome, Richard. Nicole Garzon-Mitchell, Chief Legal Officer, SVP Corporate Development at Glass Lewis. Welcome, Nicole. Paul Hunter, PIC's new CEO as of 1st of November. Congratulations, Paul, again, and welcome to our event. Georgina Marshall, Global Head of Research at ISS. Welcome, Georgina. Sarah Wilson, founder and CEO of Minerva Analytics Ltd. Welcome, Sarah. And of course, last but not least, the panel is moderated by our esteemed BPP OC member, Evan Epstein, professor at UC Law San Francisco. Evan, thanks so much for moderating this and, of course, helping with bringing all these speakers together. The floor is yours, and we look forward to listening to how proxy advisors, service providers, as was correctly noted before, view themselves, and also the myths and perceptions of the market regarding what they do and what they offer in corporate governance. Thank you.
All right. Well, thank you very much. It's a pleasure to be here. It's a nice morning here in California. I know some of you are in the UK, so it's the evening, but also what a time to be alive. All of you are aware of the politics of what's been going on in the United States, so that will have some implication to maybe your services and how the market evolves. But this panel is on service providers' views on best practice principles. And it's great to have your voice here for stakeholders to hear about what you're doing. I know there is, on one end, we heard about some issuer concerns. We've always heard about media concerns, regulatory concerns, but also a lot of good things happening, particularly from your clients, from institutional investors. And it's at some level a polarizing topic, but we want to have your voice to clarify a lot of the myths and realities of this market. So maybe we'll start with Nicole, and I'll ask you, Nicole, how do you think about communicating to your stakeholders, particularly towards your policies and practices for engaging with companies when you give recommendations? Maybe people don't understand how that operates and they think it's a black box, but maybe let's start with you and give us a little bit your view from Glass Lewis perspective.
Happy to, Evan, and thank you. And before I begin, I'd like to thank everyone who helped put together this forum. I think so far we've had some really great insights from panelists and speakers. So I appreciate Konstantinos, the IOC, and everyone involved, including the service providers. So Glass Lewis really believes that engagement is crucial for fostering transparency and understanding in the corporate governance ecosystem. I think there's a big misconception. I think Peggy talked about this in the last panel about how proxy advisors are actually available to speak to companies about our research policies and methodologies, about the company's perspectives on governance practices, their unique circumstances, and to clarify specific issues that companies have in their public disclosures. I think each service provider approaches this differently. For Glass Lewis, for example, our engagement program, we spent a significant time and resource commitment from our research analysts on this. Just to give you an idea, last year, our Glass Lewis analysts conducted over 1,300 meetings and calls with companies, dissident shareholders, and shareholder proponents. One thing I wanted to clarify, and I think someone on the other panel mentioned this as well, is we do not meet during the proxy solicitation period. And there are several reasons for this. Our policy obviously is to ensure that our research and advice remains objective. And so we don't want to create any appearance of conflicts during the busy season where we're putting together all these reports. But also, as you could appreciate, Evan, it's impossible for us to engage during this season and do the reports. So there's a balance there between when we can and cannot meet with companies. However, if there is a clarification, a factual error, or something that the company would like to bring to our attention or submit additional documentation, that's always a possibility. And as Maureen from FRC pointed out, I think there's a lot of information out there on all of these topics, particularly around engagement. If you go to our website, you can find our issuer relations policies and procedures, and we update these annually. So in there, you'll see an outline of these practices that we carry out as it relates to engagement. And last but not least, I want to mention, Glass Lewis has always been a proponent of being transparent around all of its engagement activities. And so in addition to us engaging with companies outside the solicitation period, we always add a disclosure note on the cover of our proxy paper research report. Not only on when we meet with companies, but the date, who we met with, the topics that were discussed. And in addition to that, we also provide companies with the IDR, which is an issuer data report. And this essentially allows companies to check the key data that we will be using to formulate these reports. And that's another way in which we engage with companies. So, as I mentioned, we're very committed to maintaining an open channel of communication with companies and other interested parties. And we do this in a way that's transparent and doesn't really compromise our ability to provide objective advice.
So let me ask you a quick follow-up on that. So clearly, and this maybe follows from Peggy's comment that she always had the time from proxy advisors. Maybe Prudential is a very important company. And I was thinking, is there a difference between being a large cap, mid cap, small cap, and maybe obviously somebody that is very influential, maybe S&P 500 gets more of a advice from proxy advisors than maybe a small cap that maybe doesn't represent so much. So is there a difference on how you treat different issuers on that level?
Well, I want to say that it wouldn't be advice because we're not actually providing advice to the companies themselves, but we're engaging with them. So we're helping them understand what our policies are, key issues that they feel maybe we need to pay attention to when we're researching the company itself. And to your question, there isn't really a one-size-fits-all approach to how we address who we meet with. It really depends. There might be a small company, a small cap company that has an activist situation this particular year, or there might be an exec comp proposal that is garnering a lot of attention with our investor clients in a particular year. So it really doesn't, it depends. It's driven also by our research analysts and who they think would create more value meeting with ultimately to our investor clients, right? So when we engage with these companies, ultimately that's additional information that we can, better use to create our research reports. And so there's a process through which we decide which companies we engage with.
Okay. Well, that's great. And it's good to know. Maybe I'll move with Georgina at ISS. And, we've been hearing that there is some media backlash and in terms of perceptions on how proxy advisors operate. And the question to you is, how do you deal with this? How does ISS deal with communications with media? And what is your approach? Maybe now it's going to be increased media attention. I don't know, but maybe you can clarify these questions which aim at the principle number 3 of the principles. You're on mute.
Thank you. Can you hear me now?
Yes.
Great. Well, thank you, Evan. And I'd also like to thank the BPP OC for the work they do for setting this forum up and for the opportunity to talk. And it was very heartening to hear in the first panel today the positive progress that many stakeholders are seeing across the board. And that was great. Anyway, to your question, well, first of all, my view is we've always, my experiences at ISS, we've always had a lot of periodic, media attention on our recommendations, but actually it's not something we seek. We're writing our reports and providing our recommendations for our clients. Sometimes we will make information available from our reports to the media, but on a very selective basis. It's not something we actually seek. We're not looking for publicity for ISS recommendations, whether that's for our benchmark research, and certainly not for at all for clients' customized research, which, has been touched on quite a few times today, is such a big part of what we and other service providers use and what our investor clients use as well. So I think we can't necessarily help how our recommendations are portrayed in the media. Sometimes actually companies or others will actually quote our reports in their media reports, and it gets picked up that way. Again, it's not something that we encourage or seek. As long as it's truthful, then that's okay. We don't mind it. It's nothing particularly secret about our reports, but they are written for our clients. And we also don't want to some of the points that were made on the panel earlier. One of the reasons we don't seek media coverage is that actually we're not seeking influence in that way, and we hate our recommendations to be perceived that way, or that it's something that we seek. Not at all.
Okay. No, that's interesting, and obviously that it doesn't depend so much on you, what the media does and what they print or what they are writing about. Clearly, there's going to be, to the extent there's a lot of contested elections and a lot of different cases going around, ISS does play the recommendation a bigger role, or at least it will be very media centric. Maybe I'll move to you, Sarah, in terms of being one of the initial signatories on the BPP group. What has been your experience being part of this group in terms of subjecting your company to a series of principles, and how do you perceive that obligation vis-a-vis the market and maybe expectations from shareholders and others on the view of proxy advisors, and what do you think it represents for you to do this work and work with somebody like us who are the oversight committee? Sarah, I don't know if you are with us and you heard the question.
I am. Unfortunately, the internet is like a piece of soggy string today, regrettably. So yeah, I think that returning to your opening statement about addressing some of the myths and misunderstandings, something that Maureen was saying, and something that came out of Jen's commentary about there is no shortage of information, but there does appear to be willful misrepresentation, a continuation of myths. So I think a forum like this is actually crucially important for getting things out and airing the issues so that we can actually have some straight talk. Now, one of the critical issues here is that the OC respects and understands that we all have different business models, and that what is appropriate for one service provider isn't necessarily appropriate for another. So let's take, for example, engaging with issuers. Well, number one, I think we need a common understanding of what engaging with issuers actually really means. But secondly, our clients have asked us specifically not to engage with issuers. And the reason that they've asked us not to do it is because they have seen that there is too much emphasis on service providers and not enough emphasis on them as the capital providers. So asset owners are being pushed to the back seat, and actually they should be front and center because they're the ones who are exercising their ownership rights. So we are here as humble research servants for those asset owners who are making these tremendously important decisions. So it's great to hear from Edouard and others about how they approach this. So transparency, transparency, transparency. And some more honest dialogue. We do actually have a partner who does undertake engagement, interestingly enough, and they just told me recently that 75% of the companies that they had approached declined to engage with them. So the arguments need to be a little less one-sided and more of a two-way flow. And I think that Maureen's absolutely right on this, in that we need to dial down the temperature on some of these things and work from an absolutely fact-based perspective. So therefore, the OC's role in getting to the nub of these issues and getting some of the first order questions out of the way, I think is crucially important. And particularly, as you've hinted, the regulatory environment may change quite drastically in the next 3 to 4 years. And I think that if there is going to be a regulatory debate, it has to be based on facts. We aren't proxies. Just want to make that clear. We're not the proxy. Actually, it's the chairman of the company who is the proxy. We're research providers. We're service providers. We understand data. We parse thousands of disparate documents every year. And so from that perspective, that willful misrepresentation has just got to end. It's not productive. It doesn't help companies get to where they need to get to. It doesn't help shareholders get to where they need to get to.
Okay, well, thank you for those comments. And clearly there's a lot to some of the issues that recommendations go to. And maybe, Paul, I'll go to you because maybe part of your focus is also on ESG. ESG, as we all know, has been, at least in the United States, a polarizing topic, not so much in Europe or the UK. And so there is a different view of what investors should be doing, and we've heard and seen how different institutional investors have approached this to the point where Larry Fink from BlackRock has said that he's not using the word ESG anymore. It's been weaponized. And so I'm very curious on how you address your recommendations on ESG and what is your methodology and how do you see this going forward, knowing that maybe it's more polarizing or politicized than ever before.
Thanks, Evan, and I'm delighted to be here. 6 days into my new role, so it's great to be on the panel and participating in the discussion. I mean, certainly for feedback from our clients is that they want to see ever greater focus on environmental and social issues. We provide engagement services separate to what we do on the voting services, and certainly when we look at that and listen to our clients in terms of what they want us to be engaging companies on, it's a very strong emphasis and perhaps a bias towards environmental and social issues over governance ones. And I think it's completely understandable in terms of the risks that they face, both on the social and environmental space, and therefore we have to be responsive to that, and that extends beyond engagement. So clients are asking us to provide advice in terms of the voting research that we do on environmental and social issues, and clients are also facing their own pressures, especially on the asset owner side, from beneficiaries who are particularly interested in what they as pension funds are doing in terms of their stewardship responsibilities on be it climate or human rights. Obviously, corporate governance codes are focused largely on governance issues, so we have to look elsewhere as the starting point, really, for our analysis. So looking to investor expectations, and also to standard setters in terms of the starting point for our policy, and then for analysis. And certainly from a client perspective, they would like to see where we've got a client that's we're providing engagement and voting services, like to see some alignment in terms of what we're engaging a company with and on, and what voting advice we're providing to them. So as a starting point, I guess we're all having to grapple with ever increasing levels of shareholder proposals, and have to have frameworks in place to assess those proposals, or if we have to take those on a case-by-case basis, because each one will be different. But nevertheless, we look to those investor expectations and industry standards that we'll use to assess whether we think the proposal is a good one or not, and therefore should be supported. But our clients also want us to go a bit further than just advisory votes, and also look at standing items. So we have a framework to look at issues around social issues and issues around the environment, in which we use to then provide advice on a range of different agenda items. And we're also going further than that at the moment, and looking at areas where the risks are higher, so sectors or companies that face specific risks. So obviously things like SASB identifies those kind of sectors which face specific risks. So again, we're looking at providing a bit more of a deep dive in terms of the analysis that we provide on those specific issues, and I guess it follows a similar approach to our approach in terms of engagement, which is focused on perhaps a smaller set of companies where we see the material risks are higher, and where our clients want us to focus our work on. So it's perhaps a bit of a departure in terms of taking a kind of universal approach to corporate governance, and having a more specific, focused approach to these issues where we see the risks as being most pronounced. And I think that's certainly something we think will develop further over time. Obviously, we've started as be led by clients in terms of climate change, but I think that's going to only increase out and beyond that to other specific ESG issues.
Okay, and maybe we'll come back to that, because I think there's a lot to it. Richard, maybe you can tell us a little bit about what types of engagement services you provide, and maybe how different all of your signatories, the services, maybe it's not all the same. Maybe Glass Lewis, ISS, and Others have different methodologies, different services. Can you give us a little bit of your focus on what you are doing and maybe how you're doing it differently in the market?
Yeah, for sure. And I think I'll echo the panelists in thanking the BPP OC for giving us this opportunity, putting this panel together and all the work that's gone on in the background. It's been a pleasure and it's an honor to be part of it. I think in terms of what we do at EOS at Federated Hermes Limited, we are a broader stewardship service provider. So what I mean when I say that is that we encompass a lot of things that we do in the general stewardship sphere. That includes voting recommendations, which we provide for our clients, but also company engagement, thought leadership pieces, et cetera, et cetera. And so I think it probably plays into some of the comments made by earlier panelists about how the universe of what we do as members, particularly the BPP signatory group, is so vast and so diverse that we have, we can't be characterized with one brush, and it's unfair to do so. We all provide different services, we provide different approaches, and they're led by our clients. So we're not necessarily going out there to try and seek influence or generate headlines for the sake of our business model. Everything we do is informed by our clients. To touch on engagement, we have a bespoke engagement plan, which is informed by our assessment of what clients have determined to be big issues or systemic issues they would like to see companies engaged on. Typically, they use us for that service because they are asset owners who simply don't have the capacity or team to conduct engagements in the way they want or to have the impact they feel they would like to have, which is why they use our service. That's not going to fit for every single asset owner. And a lot of asset owners, I totally echo Sarah's point, should have a lot more primacy in these discussions, where we're able to leverage our size and our expertise to help engage on topics for those clients who want it. That's what we try and do. And so we engage across a broad range of topics across the whole sort of sustainability and strategy spectrum, from all sorts of ESG issues, things around company ownership and governance, all the sorts of things like that on a company by company basis. And we also do public policy work and trying to influence market standards and developments of things for basically the end goal of benefits for the stakeholder groups we represent. So that's stuff around shareholder rights, that stuff around global approaches to things like climate change and natural resource stewardship, all those kind of things. So it's quite a broad bucket of what we do. And so it means we have quite a varied day job. But again, I think I'd draw it back to the fact that we, as a stewardship service provider, are not the same as a Glass Lewis, not the same as a Minerva, and not the same as Perk, but all of us feel and contribute to an ecosystem in a way that suits us and is driven by what our clients want us to do. And so to try and narrow it or box in I think is potentially an unfair portrayal of the different services we provide, and does us disservice to the sort of work that everyone tries to do in their own sort of space. We're all effectively, at the end of the day, trying to do what's best for our clients, who are all, at the end of the day, the asset owners of capital.
Okay, so I've asked each one of you individual questions. Now I'm gonna ask a general question, so you can any of you can take it. And if people have questions in the audience, you can just I think there's a Q&A box there. You can send in your questions there. But my first question here is going back to the US. This pushback on ESG has driven a growth of pass-through voting. And people say, well, maybe this is a methodology that will allow different customers or clients to have their voting, which is different to what the custom voting is from the different proxy advisors. And maybe you can explain how that would work and how your focus. I'm sure all of you have been monitoring this and probably have some sort of service towards it. And I don't think people who are not in the industry understand how this works. And maybe I'll just throw it to you, Nicole, first, in terms of custom policy versus client policy versus the idea of maybe pass-through voting, and how do you see that going forward in terms of the vote, and how people will approach that process, if any way differently than in the past?
Happy to, Evan. And I think I'll start by explaining how things have changed. I've been at Glass Lewis for 20 years, and things are significantly different than what they used to be back then. It is true that, most of us, and obviously I don't speak for everybody, but for Glass Lewis, we have a benchmark policy. And this benchmark policy is what people tend to focus on. But that's not what people should focus on. As several of the panelists mentioned, the prior panelists mentioned, investors have their own policies, and those policies are largely based on their investment strategies, time horizons, as well as their views on proxy voting issues. So for example, a hedge fund may prioritize short-term returns, while an asset manager might have a passive retirement strategy for 30 years or more, right? So what we've done throughout these past few years is, at least at Glass Lewis, is we've allowed our clients to have the ability to, one, rely on the benchmark policy, but I can tell you from experience that a significant majority of our 1,300 clients actually use a different approach, which is either relying on a thematic policy or even further flexibility on a custom policy. And what that means is we have off-the-shelf thematic policies that investors can choose from, and those might range from climate-focused, governance-focused exclusively, so stripping out or maybe not relying on social and environmental issues, Catholic policy, the like. Some clients choose to start from there, and then they tailor it further and they make it their own. Other clients have their, entirely own custom policy that reflects their specific views. And I think it's important to note.
Can I ask you, but
Sure.
just to get clarity, how many of these policies, predetermined policies, do you have in place for customers before they start going and using their own custom preferences?
So clients can come and they can start from where they want. They can say,
Right.
I don't want to look at your policies. Here's my
Right.
own. I already know what I want. They can start with our benchmark policy and tailor it from there. They can start with one of the thematics. And the reason we have the thematics is because, as you rightly pointed out, we have a vast majority of clients throughout the world, and they have different views, right? Our European clients tend to focus more on ESG, whereas we might have pension fund clients in states where they don't want to focus on ESG. So we've decided to create these thematic policies to allow them to start from a further step than to just go to the benchmark policy.
And that was my question. How many of these thematic policies do you have? I'm just curious because I'm sure this evolves as time goes by.
I want to say we have about 6 or 7, but don't quote me on that. I just remember a chart that we have where we have the different ones.
Yeah.
But as you point out, we've evolved and we've created these thematic policies to the extent that something happens in the world and there's a shift and we need to create a new one. We'll revisit that and we'll put one in place to cover the needs of a specific client segment that we might have. But I want to just, go back to the point where people tend to focus on the benchmark policy and indicate that we have all this influence and that clients are blindly following us. One clear example that has struck with me and that I like to mention out is the Disney contested election. So Glass Lewis recommended backing all of Disney's 12 directors, but voting results actually showed that several of our clients actually back Peltz. And so that might have been for one reason or another, but that's a clear example of how our clients are actually voting independent of the research and the vote recommendations that we're actually providing them.
Mm-hmm. And maybe I open it up to others, maybe Georgina, to you, and how do you think about these topics and the evolution of custom policies versus maybe thematic themes and other individual choices that shareholders may want to have?
Yeah, well, thank you, Evan. And you're certainly right that this is a field that's changed a lot over the years. At ISS, we have our benchmark policy, and by the way, that's actually well over 20 different market or regional specific policies. And we also have what we call specialty policies, which are thematic, as Nicole was describing for Glass Lewis, because we are serving a vast number of different types of investors with different views and needs. Actually, it's not views, it might be to do with it might be to do with the underlying clients that they're serving. So we have ISS benchmark policy, 7 thematic specialty policies as well, ranging from pretty strongly pro ESG to actually almost entirely governance related and everything in between. And that's changed enormously over the last few years. In fact, at least one we've introduced in the last year, and I expect it'll be a constantly growing suite as we see the opportunity for different groups of investors who might share similar base views. We also, one thing I might mention that would be probably interesting to the audience, that of all the votes processed on behalf of our clients, over 90% are associated with a client who uses one or more custom policy. So the growth of customized research based on clients' own individual views has really taken off enormously over, I would say, the past 10 years or so. So what we think about is serving the wide range of different clients we have, whatever their views and needs, with something that will suit them, whether it's, in fact, many clients will take more than one type of research from us because they want to see the different perspectives through a different lens, if you like, of what's on the ballot, or they, as I mentioned, will have different needs within their own portfolios.
Okay, no, that's very interesting, and I think it's something worth monitoring to see how these decision-making process happens. You know, yeah.
Sorry to interrupt. May I just mention one thing? But thinking back to the last panel, and what one of the panelists said about seeing different recommendations. I don't know if they were which provider they were referring to, but actually, I would say that in principle, we are very happy that we have different recommendations across our different types of policies that we offer to our clients. It's by intent, not by any kind of accident.
Okay, Sarah, I think you had your hand raised.
Yeah, I think this is a super important question that you've raised, and again, this is where respecting and supporting diversity. Peggy was very clear about her worries about consolidation and homogenization, but I think every signatory here has demonstrated that they bring something different to the party. And one of the things I wanted to flag up is that actually pass-through voting is not new. It may be being talked about more, but actually it's something that we've been doing for 30 years. The reason being is that, as Georgina has rightly pointed out, there is no such thing as a one-size-fits-all investor. They all have their own investment thesis. That's why we have so many different fund managers out there. They all have their own individual thesis, and they're not just applying a homogenous one-size-fits-all. And I wonder a little bit where these messages come from. And I would, if there are any boards listening, I think it really behooves them to really be questioning where they're hearing this from, that investors are all doing X or investors are all doing Y. You know, we are in a market, it's an open and competitive market, and on any given day, people are buying shares, selling shares. There are lots of sell-side analysts, ESG analysts, you know, there is such diversity out there. But asset owners historically were defined benefit pension schemes. They owned shares in their own right, but increasingly the sort of the mechanical nature of some aspects of investment management intermediated them, and they suddenly stopped being owners, and they were asking their managers to help them be the universal owner that they always used to be before. So yes, it's new because more people are talking about it, but actually it's really very old in that, you know, it has been something that many asset owners have been doing, but they were doing it quietly behind the scenes. And I think Richard's firm, Hermes EOS, also represents a kind of pass-through voting because they were consolidating clients. I mean, he can talk about that in more detail than I can. But again, another example of the diversity that there is in this industry. That's not good news, I suppose, for companies in that they're going to have to reach out and talk to their investors directly, but that can only be a good thing, that they're actually going directly to the capital providers to understand what motivates them.
Mm-hmm. Okay, no, that's great. And, you know, this is obviously something that we'll have to keep monitoring, and it's interesting to market players. Maybe Richard or Paul, I'm curious about how you're approached as being a signatory and the process in which you've been working. And I know, Paul, you're just starting as a new role, so it's a little bit unfair. But how do you view, you know, maybe feedback and the role of the oversight committee, and how that can help your mission, and, you know, feedback that you receive or not, and also this self-monitoring process, in which is different to maybe other you know, financial services. And I'm curious, and this may be also to everybody, but I'll start with both of you, maybe to you, Richard, and then we'll go to you, Paul, as you're starting this new role. And how do you see this? You know, maybe it was explained to you on how the oversight committee operates, and it may open up other questions or comments.
Yeah, I mean, I'm happy to go first. It'd be unfair to put Paul on the spot, I think, so soon in his tenure. But I think from my understanding, looking at when I think about the process of going through the oversight committees, being a signatory, reporting, taking on feedback, etc., it strikes me as being a critical part of us basically walking the talk about what we say we do. If we're going to position ourselves as a differentiated market with lots of service providers who have unique models, we should be able to discuss that, disclose that, and have things that we can talk to people about in a manner that fits everyone appropriately. And I think the process for us of going through this sort of reporting cycle of taking on feedback and proving along a set of principles that have been agreed, not just by us as a group, but by an independent body as well above us, shows that there's something we can all refer to and actually have something that's tangible when we talk about our work and report on our, facts and figures. So I think from our perspective, we found the process of being a signatory in the sort of reporting mechanism, along with this general discussion, as being really, really valuable for us in terms of forcing us to look inward and justify the things we're doing, and also report and disclose on it more broadly. I think we've iterated.
Maybe Richard,
Yep,
can you give an example of something that maybe feedback from one of your submissions and something that you changed thanks to the OC? Is there anything that stands out there?
Yeah, I was just about to say that.
Okay.
I think one of the most important things we've done in recent feedback has been giving more of an update on our service complaints procedure, and also some of the things we've done around methodology for data collection, and also managing things like conflicts of interest. We had that as specific feedback points from the OC at different points around what more information can we provide, and also stuff around things like data around diversity in our workforce, background data in terms of different elements of diversity, how that makes up our team and what that means to us and how we approach it. So those have been specific, tangible points that we've had in sort of discussions with the OC and also through our reporting that we have not had an issue disclosing. It's made us think, oh, this would be useful for us to give more color, and people, clearly there's a demand for it. And so we've been able to build that into our process. And so, yeah, I think it's been for us a very fruitful feedback loop. And we continue to see significant value in the work of the BPPG, the OC, and we're very happy to keep being signatories and keep reporting against that kind of framework.
All right, that's great. Okay, Paul, we'll put you in the hot seat. How do you think about this and going forward as the new CEO?
Yeah, thanks. So, I mean, I guess an analogy, a similar example is which I've experience of is around the stewardship code, and writing and thinking about our submission to the FRC on what we do on stewardship more broadly, and similar to Richard, that process itself, and it's not just the final outcome, it's the process itself which enables you to think about what you're doing, ask some searching questions about what information you're disclosing, but also your internal procedures. So it's not just about the actual disclosure, but actually your actual actions and processes you have in place, and making sure that those are robust and fit for purpose. So I think, firstly, the process is incredibly important. And then secondly, I think the feedback will be incredibly useful. Already seen the letter that was sent in terms of areas where you would like to see some areas of improvement from us, and I will certainly be looking through those in the coming months, ready ahead of our next compliance statement submission. And certainly be wanting to improve what we do in order to improve the transparency around what we do, and ultimately to improve the trust that was mentioned in an earlier panel, that investors want to see, that they can trust the services that we're providing, making sure, across those principles that not just the service, but also addressing any conflict of interest issues, and also being able to communicate those quite clearly with all our stakeholders.
Mm-hmm. All right, that's great. We don't have that many minutes left, but I do want to ask the tough questions, and I'm thinking about Peggy, Foran, in our last panel. one of the concerns she mentioned was the concentration of the market and how proxy advisors who she said that maybe have thin margins and it's a tough business. And that's a concern she had over how proxy advisors are going to advance. And I want to, you know, put it out there in terms of how do you see this market advancing, and maybe it's a small industry, and you know, like I'm very curious, you know, how do you address those concerns, and potentially, right, this could have regulatory you know, implications. I'm not going to name anybody. I'm just put it out there as something that, you know,
Yeah, it's I think it's a very concerning issue that we've seen consolidation in the ESG space. Obviously, people like Vigeo Eiris leaving the market, and sort of the hoovering up of independent providers. And you know, one of the key considerations for any service provider is going to be the costs of market entry. And regulation, I think, is actually a very important part of that. Whether or not regulation actually adds value, or if it just becomes pencil pushing, something which issuers, of course, lobby against all the time. So I think that AI is a little bit hyped at the moment. I think we've seen vendors come and go because they've recognized that you need to have human beings who really understand what they're talking about and actually understand these disclosures. If I was an issuer, I would be terrified of some algorithm getting hold of the annual report and making a recommendation off the back of that. I think that issuers actually should celebrate the fact that we collectively employ hundreds of people who are very, very thoughtful about what they do. But yeah, more questions definitely need to be asked. But investment research has been such a vexed issue for so long, whether it's under the MiFID rules, analyst objectivity standards, etc. It's always been a contentious issue. So, you know, the more the OC can talk about this, I think the better. You know, fund managers don't tend to go to market. They don't tend to do invitations to tender. So there's not like in the audit industry where there is a rotation. So yeah, maybe there are some other issues that regulators should be talking about rather than really unfounded allegations about, quotes, errors. Voting levels for companies are astonishingly high. Investors support companies over 97% of the time. That's an extraordinary record. Even presidents don't get that level of popular voting.
Yeah, no, I think that's interesting to point out. And you mentioned something that is, you know, here sitting in San Francisco, that the most important topic, which is AI. You can't really walk a block without somebody raising $1 billion or more. And everything is turning around AI. And, you know, Magnificent Seven combined is $15 trillion. And so everybody's thinking about how AI is going to impact their own industry. You are a data-driven industry, and you point out hundreds of people that are doing this work, but that's precisely what AI is supposed to kind of fix, and we'll have to see how that evolves. But how are you approaching AI? And the last panel talked about AI washing. I don't know if they talked about vote washing,
Yeah.
or both AI washing and vote washing, but this seems to be something that is very important, and maybe all of you, I'm sure, at the board level and your own companies have committees or some level of discussion about how to incorporate AI in your work. Maybe any of you want to comment on this new trend?
Yeah, we've been using data science.
Sorry, Georgina raised her hand, so I'm going to go with Georgina.
I'm happy for Sarah to start, and then I can go up.
Yeah, so we've been using data science techniques for many years, but there is something that, you know, I started in the data industry 40 years ago, and we were always taught garbage in, garbage out. And that's the problem with any model, is if you're not dealing with high quality inputs, the outputs are going to be atrocious. But so many issues are so subjective. I think it will be quite some time before we see models have the nuanced understanding that a human being can have. Heavy lifting by machine learning, that's one thing, but you know, we'd like to see issuers using XBRL so that these allegations of errors they're not really that many in practice, that we can iron those out. But yeah, of course it's an issue, but we've been through bubbles before.
Okay. Thank you, Georgina.
Yes, thank you, Evan. I was going to say that AI is definitely an overused term at the moment, and I also had never heard AI washing, but I can see that, right? So to me, it's another piece of, and to us as an organization, it's another piece of technology that we assess as we...
Maybe let me tell you, maybe not everybody knows AI washing, at least in the US, refers to actually SEC going after companies or issuers or providers claiming that they use AI for a certain service, and it turns out it's just to magnify, you know, whatever resources or revenues, and it's fake, and it's actually fraud. So there is AI washing that the SEC is going after. And this is like greenwashing, but AI is kind of the new frontier of how people are using this, you know, a pixie dust to say, hey, we are the latest AI company, and look how much you got to pay for us because it's going to solve all your problems. That's AI washing in a short sentence.
Yeah, thank you, Evan, and that relates very closely to my point, which is that it's another piece of technology. Does it matter whether if it's AI or other technology? We assess and continue to assess things, the ability of technology to help us in what we deliver for our clients. We actually don't see that and don't want to get to a point where voting recommendations, which are the quality of those are so important for our clients and for issuers as well, are done by AI. But there are places in the processing, like collecting data that companies disclose, for example, or in internal processing, where it could be very helpful. But we assess it as we do with other technology that's come along over the years.
All right.
Like
What about
on what Georgina said?
Okay.
You know, at Glass Lewis, we created an AI committee this year. We put in an AI policy, and as Georgina pointed out, it's another technology that we could use to help simplify. For example, we have, you know, we cover 20,000 shareholder meetings a year. So, and most of the filings are in foreign languages. So an easy way to simplify that would be to leverage technology to help with interpreting some of those filings in different languages, or, you know, gathering data. But I think there's going to be, to Richard's point, it's going to be a while before we explore replacing humans for AI. I think it's not cut out for what people say it is. Having used it personally, there's a lot of flaws and mistakes and hallucinations caused by AI. And I think, you know, we have a fiduciary duty to provide independent and objective and very thoughtful advice to our clients. So I think that's something that I probably can speak for all of us. We will be careful in how we approach and use AI in our industry.
Paul, what about you and Richard?
Yeah, so very much a similar place, really, in terms of seeing the potential benefits, looking and exploring what they might be, but also very cautious about the limitations that and risks associated with reliance on AI because of issues that we see in terms of accuracy of the information that it churns out. So we will certainly be looking at AI as an assistance, as a tool to assist researchers. We will always have human oversight over any information that's provided to clients. I think that's something that we won't be moving away from, and certainly will be insisting on as we look to use it more broadly.
Okay. Richard?
Yeah, I think I'm probably aligned with a lot of with the entirety of the panel. I'm probably not that fun at parties. I don't like talking about AI. It kind of annoys me a little bit that it's proposed as a panacea for a lot of things. I think there are definitely productivity aids that it will help with. I also think that the strength of the relationship between our industry and our different provisions and what we do is that there is a human element, there is an art to it. It's not entirely boiled down to an algorithm or a science. And I think that people who wish to automate that entirely may probably be careful what they wish for. If a computer says no approach comes to the next time they have a vote that doesn't go the way they want, or they have an engagement that doesn't land with the objectives they would like. So we will definitely be very cautious in our adoption. We have internal pilots about things we could do to help aid, taking out some of the, perhaps, for want of a better phrase, more menial work in terms of processing and things like that. But I think we'll always be very committed to providing a service that is focused on what we as ourselves as humans and the engagement team and the service team could do, because we think that's the best value proposition for our clients. We believe that what we do is important. We care about it. We have an investment that goes beyond, just lines of code, etc. So I think we'll always want to put ourselves and focus on a human-centric model where we can. So yeah, we'll definitely be taking a step-by-step approach, but I don't hopefully foresee it being a massive shift, more of just an initial aid that helps us to do even more productive work in the field that we do.
Wow. So none of you are concerned about AGI and breaking out here. Okay, so we are ending our panel. Maybe I'll give you a last word on is there anything that you want to say to stakeholders, to this forum, to others about your work, about what's going on with the OC or the principles? Maybe I'll start around, and we'll start with you, Sarah, and we'll go around the room to just give you an opportunity to say one last word about this process and your companies.
Yeah, sure. So obviously we need to up the engagement between the stakeholders and get more voices at the table, dispelling myths and getting down to the brass tacks of the accountability between owners and investee companies is a critical path that we're facing in the next few years. So I just think we just got to keep on going. Get everybody in on the conversation, keep dispelling these myths, and actually understanding it's a vibrant and diverse market. It's not all one size fits all, and keep on keeping on.
Okay. Nicole, we'll continue with you.
You know what Sarah said, I think there's a lot of misinformation out there. I think the market has evolved significantly in the last few years, and people still have the views that proxy advisors and research service providers are influential, that investors don't have their own say on these things, that we don't engage, that we don't have our methodologies out there. And it gets kind of old because we have a lot of disclosure. At least I can say from the Glass Lewis side, if you go to our website, there's a ton of information there. So I think it's educating people and helping them understand that we've changed, that the BPPG and all the work that we've done has helped us also improve our policies and procedures and make us better industry players. And so just encouraging them to engage with us as well, and also just look at the information that we put out there on what we're doing and how we are complying with the principles.
All right, great. Georgina, we'll continue with you.
Yeah, thank you. Actually, I'd echo much of what Nicole and Sarah had said. ISS was a founding member of the Best Practice Principles group because we have always believed in transparency. But I think coming through the process since the principles were involved, and particularly since the Oversight Committee was put in place and has really worked with us, has really helped us to evolve even more. It's not enough now to put everything on your website, which we do. You need to get the message out more. It's not only a diverse world for our clients, it also for issuers and other stakeholders as well. So the more that we do through BPP and the work of the OC to help get that message around and as we improve as well, I think that's all to the good.
Great. Richard.
Yeah, I think I would just say that we, as EOS, and I think the panelists across from us, we're very much committed to the work we do, and we remain committed to upholding the best standards and the best approaches we can for our client base. So the work of stuff like the BPPG, the OC, the continual oversight and iteration improvement is a journey we're very much happy to be on and want to be as actively involved in as possible. So we really welcome not just the feedback from the BPPG itself, but panelists and also audience attendees like today. So remaining committed to the cause is something we're very happy to do.
Excellent. All right, Paul, you're our last one.
Thanks.
Last but not least.
Thanks. No, I echo everything that's just been said. I mean, we're a founding member, fully committed to upholding the principles and the highest standards. Indeed, we expect the highest standards on behalf of our clients and companies. So I think it's incumbent on us to hold ourselves to high standards. So we will certainly be continuing our involvement and looking for, I'm personally looking forward to greater involvement with the BPPG over the coming months and years.
All right. Well, with that note, thank you everyone for doing this panel. This was great. I think it's been a great way to convene all of you and your work, and the Oversight Committee is always thankful for everything that you do. So I'll hand it over to you, Konstantinos.
Thank you, Evan, and thanks everyone for keeping the time. I appreciate it, and thanks to our panelists. Very, very insightful discussion, especially in order to remind our audience and our stakeholders that myths keep on existing, but we have to keep on working in order to address and dispel them. Now, I have the great pleasure in sharing with the audience today Carmine Di Noia's keynote speech. And I'm saying sharing because Carmine had a last-minute engagement, but he very kindly recorded his keynote for us, and we'll be sharing it now with you. Carmine Di Noia, of course, does not need to be presented in a detailed way. I'm sure you all know who he is. He's Director for Financial Enterprise Affairs at OECD, and he's also a professor at Lewis University, amongst many, many other roles that he has in the corporate governance sphere at the global level. So without further ado, I am now passing the floor virtually to Carmine, while thanking him so much for recording his keynote for BPP OC Forum today, and then I will be back for the closing remarks. Thank you.
Okay, good evening to everyone, and apologies for not being with you live in person, but I'm actually in this moment on a flight. Thank you very much for this invitation from the Best Practice Principles Group, and in particular from I'm very happy to know since a long time Konstantinos Sergakis, your great chair. And I'm happy also to be with you, because I remember when also the Best Practice Principle Group was formed. I was in the stakeholder group of ESMA. I've always been a strong supporter of this interaction and interplay between regulation and self-regulation, including the monitoring. And I found that the functioning of the Best Practice Principles Group has been quite effective, including with the monitoring. So I'm really grateful to have this opportunity to give you some remarks about the importance of the proxy voting research industry for corporate governance, which is well recognized in our legal standard, the G20 OECD Principles of Corporate Governance, as well as in our work. I know today's audience includes some of the main actors that they inform how votes are cast in general meetings around the world. And I hope that some preliminary findings of our forthcoming OECD report on general shareholder meeting policies and practices can provide insightful inputs to your discussion and work. Now, I will first underline the relevance of the G20 OECD Principles of Corporate Governance for your industry, and their complementarity actually to the 2019 best practice principles, the updated version. Then, before giving an overview of some of the findings of our peer review study, I will first go into the details on the scope and coverage of these OECD peer review. I would like to start by underlining that the G20 OECD principles do recognize the role of the proxy voting research industry for corporate governance. The principles aim to help address the disclosure of conflict of interest by advisory services like proxy advisors and the ESG index providers. This has been the case since 2015. The principles now have 25 years and were first adopted in 1999. Their revisions over time keep them relevant and the global standard for corporate governance. Importantly, it was in the 2015 revision that a third chapter dedicated to institutional investors, stock markets, and other intermediaries was added. And Chapter 3, including for the first time Principles 3D, which called for the integrity of proxy advisors. Already in 2015, the annotations to the principles encouraged the implementation of self-regulatory codes designed to mitigate conflict of interest or other risks related to integrity. With this background, the current approach of monitored self-regulation for proxy advisory firms, established in 2019 by the Best Practice Principles Oversight Committee, finds its validation and established and renewed with the updated version of the principles, finds its validation in the global standard for corporate governance endorsed by OECD and G20 member countries. Since then, the self-regulatory solution for proxy advisors has been also endorsed by ESMA in Europe and the SEC in the United States. But continued monitoring of its effectiveness remains key. As all standards, it's important to have them, to remain relevant, to update them, but then the implementation and monitoring is the key issue. Now, the 2023 revised principles of corporate governance have gone a step further in recognizing the importance of disclosing methodologies used by proxy advisors, as this has become a main recommendation. Principles 3D, as revised and as reported, as you see in the slide, states that the corporate governance framework should require that entities and professionals that provide analysis or advice relevant to decisions by investors, such as proxy advisors, analysts, brokers, and others, disclose and minimize conflict of interest that might compromise the integrity of their analysis and advice, full stop. And then the methodologies used by all these entities, including proxy advisors, should be transparent and publicly available. In the next slide, you can read also the text of the revised annotation to Principles 3D as relevant to proxy advisors. And the annotations highlight the relevance of disclosure of methodologies, but also add, compared to 2015, other practices as the adoption of a code of conduct, as well as having adequate human and operational resources. The G20 OECD principles are therefore strictly aligned and relevant for the 2019 principles for providers of shareholder voting research and analysis and their guidance. Your principles. Service quality, Principle 1, conflict of interest avoidance or management, Principle 2, and communication policy, Principles 3, they cover the points raised in the recommendation of the G20 OECD principle. So it's therefore important that there is a continued monitoring of compliance statements by the BPP signatories, and their public reporting is ensured. Now, coming to the peer review study the OECD is working on, this slide also lists the relevant principles concerning the role of general shareholder meetings within the framework of corporate governance. Now, these principles underscore that general shareholder meetings are not just formalities, they're essential mechanisms to ensure that equitable treatment of shareholders and to support their rights and ownership functions. Importantly, these meetings also allow shareholders to cast informed votes on key decisions affecting the company's future, an aspect which is also informed by the activity of proxy advisors. A new recommendation acknowledges the growing importance of remote participation in meetings, as well as the need for legal frameworks to ensure equal access to information and opportunities for participation of all shareholders, regardless of how shareholder meetings are conducted. Importantly for this audience, it's also Principles 3A, recommending that a corporate governance framework should be designed to enable and encourage active engagement between institutional investors and the companies in which they invest. With this background, I will now turn to our forthcoming peer review on general shareholder meetings. Over the past decade, we have witnessed a significant global shift towards empowering shareholders. And today, shareholders have a growing voice on matters that go beyond just financial returns, with voting decisions extending to critical areas such as executive remuneration, related party transactions, and even urgent and more urgent issues like climate change and social responsibility. As a result, the general shareholder meeting has become a key platform where these voices converge and where shareholders make their choices on issues that directly impact the future of companies. In recent years, the format and practices surrounding general meetings have evolved rapidly. The COVID-19 pandemic in particular accelerated the transition to fully virtual and hybrid meeting formats, transforming how shareholders interact and participate. For these reasons, the OECD Corporate Governance Committee has decided to carry out a focused peer review on the topic. The study aims to be published in Q1 of 2025 and covers 48 jurisdictions. It also includes 5 in-depth reviews of the policies and practices for the Netherlands, Singapore, South Africa, Turkey, and the United Kingdom. And we have gathered detailed information, particularly on practices of listed companies within the case study jurisdictions, and conducted interviews with relevant policymakers and regulators, but also with investor associations and proxy advisory firms in these 5 jurisdictions. The peer review includes information on several issues. I will focus on some of them today, which may be relevant for this industry. Now, as you can see in this slide, global practices for AGMs have evolved in the past years. A few AGM seasons have passed since the pandemic, and companies around the world are either readapting to pre-pandemic habits or have evolved their way of conducting meetings. A growing majority of jurisdictions allow general shareholder meetings to take place in both hybrid and virtual-only format. As for legal and regulatory frameworks, as of October 2024, virtual meetings are allowed in more than 80% of the jurisdictions, 39 jurisdictions, in certain cases subject to a provision in the company articles of association. Hybrid meetings are allowed in even higher number of surveyed jurisdictions, with nearly 90% having a framework for hybrid meetings. Regarding key trends in many jurisdictions where it is allowed, the hybrid options is rising as an increasingly common practice. According to data gathered by Lumi, a global provider of technology for real-time shareholder meetings, hybrid AGMs hit 40% of all shareholder meetings in jurisdiction where actually Lumi is active around the world in 2023, which is 31% more than in 2021. Virtual-only meetings instead became less popular, almost reduced by half between 2021 and 2023. Another important trend, which was recognized in some of the case study jurisdictions, so you can Singapore, is that in-person meetings are starting to rise again and accounted for 16% in 2022 and 21% in 2023. The upcoming AGM season will call shareholders to vote on the inclusion of amendments to the Articles of Association to allow for virtual-only meetings. This had already been the case in some countries as Canada, Germany, the Netherlands, and Switzerland. One of the key takeaways confirmed through interviews conducted for our case studies is that shareholders have concerns when proposed amendments to the Articles of Association give boards too much discretion in choosing virtual settings for meetings. And in particular, shareholders are often uncomfortable when there are no clear conditions guiding these decisions, such as limiting virtual meetings to emergency or specific situations, or establishing temporary limitations, in which cases shareholders tend to reject proposals to amend the Article of Association. This insight highlights the importance of setting transparent, well-defined conditions around virtual meeting options to ensure shareholder trust and approval. Furthermore, over the last few AGM seasons, some companies experienced disruptions with AGM that have even sparked protests, leading to increased procedural requirements and higher security costs. Also, as a result of these events, some companies are shifting or wish to shift towards virtual-only AGMs as a way to manage these disruptions. To ensure stakeholder voices are heard while maintaining a productive environment, companies may explore alternative engagement strategies. Some are organizing separate consultation and dialogues with interest groups in advance of AGM. And by building these formal channels for feedback, companies can both minimize unaccepted disruptions and foster a healthier corporate culture, one that values and respects the voices of all stakeholders, and this can be relevant and aligned to the BPP Principles 3 on the communication policy. Another important development is that more than half of the 48 jurisdictions covered had adopted specific guidance on AGMs, and most often incorporated into dedicated sections of codes of corporate governance and other types provided in specific guidance documents or Q&A formats. These have been adopted particularly in the past few years and often can provide very detailed safeguards and guidance on the conduct of AGMs. And the case studies of Singapore and Turkey will provide good insights on this approach. In this slide, you can see our findings on the framework and deadlines for both record dates and cutoff dates. Record dates provide a snapshot of shareholders that are entitled to vote and are considered an essential corporate governance element. Based on the data collected, the record date of ownership is set by law in nearly all surveyed jurisdictions. The most common deadline is 7 days, the shortest date is 1 day, and this is the case in Turkey. And the longest record date is required is a 3-month period. A cutoff date is the deadline for proxy voting before the AGM. The majority of jurisdictions do not set any cutoff date in the law, leaving this to companies and market participants' discretion. Without going into more detail, the main point is that one challenge facing investors is that both deadlines set by intermediaries and custodians often occur well before the actual date of the annual general meeting. So this timing can prevent investors from casting their votes based on the most up-to-date information, limiting their ability to make fully informed decisions. And these findings can also be relevant under the lens of the BPP Principles 3 on communication policy, which underlines how BPP signatories should provide high-quality research that enables investor clients to review the research and/or analysis sufficiently, you say, in advance of the vote deadline ahead of the general meeting. Coming to findings on the possibility to pose questions before AGM and related deadlines, we can see that these are not clearly provided for in many jurisdictions. The right to receive answers is also not widespread in legal and regulatory frameworks and code recommendations. On the left here, you see the breakdown of jurisdictions regarding allowing questions before the AGM. A substantial number of countries still have no requirements or recommendation for allowing questions before the meeting. On the right side of the slide, we see that when questions are posed, and notably 40% of jurisdictions do not require or recommend that all questions asked before or during AGM are answered. 60% lack a framework for handling unanswered questions after the meeting, and only 15% require that all questions posed during AGM are displayed in all meeting formats, ensuring transparency for all stakeholders. And this brings me to the next point, and I'm going to conclude on the importance of disclosure after AGMs in meeting minutes. The minutes of a shareholder meetings before just recording voting results are seen as a critical form of disclosure for both the retail and institutional shareholders. In fact, while approximately 80% of jurisdictions have a framework in place for disclosure of meeting minutes, during our case studies interviews, shareholders across various jurisdictions express a strong desire not only for access to meeting minutes, but for minutes that provide a true and complete picture of the discussions. They want details that reflect the full range of viewpoints, including any concerns or disagreement raised in the Q&As, rather than summaries with discretionary omissions. For instance, in South Africa, there is no obligation to include Q&A sessions in the meeting minutes, which can limit the depth of information available to shareholders. This highlights an opportunity for improvement. By providing more detailed guidance on the content of minutes, companies can enhance transparency and ensure that shareholder perspectives are fully represented. Additionally, to address unanswered questions and provide even greater transparency, some investors advocate for companies to make meeting webcasts or transcripts available to complement the minutes. To conclude, the G20 OECD principles highlight an important consensus. Regulated entities and professionals who provide analysis and advice, like you, play a significant role in shaping companies' governance and sustainability policies. To support this, Principles 3D, along with its detailed annotation, provides robust guidance. These recommendations can reinforce and complement the self-regulatory effort of the BPP Group, ensuring that standards are consistently applied and effectively upheld. Looking ahead, the OECD upcoming paper on AGMs will offer valuable insights into the policies and practices of general shareholder meetings across 48 jurisdictions. This comprehensive review may provide relevant perspectives for the BPP Group, as well as proxy advisors are essential in the voting process, offering guidance and recommendation that help shareholders make informed decisions on how to cast their votes. Proxy advisors, therefore, have a direct and meaningful role in AGMs from a corporate governance perspective, influencing how companies are managed and held accountable. We look forward to publishing the peer review next year and continuing a dialogue with the BPP Group on these themes. So thank you very much for your attention, and let's keep in touch.
Thank you to Carmen and Dinoia for such an excellent keynote, and we are delighted to see that the OECD also endorses our work and also looks forward to liaising further with us. While thanking Jen Sisson and Carmen Dinoia for their two excellent keynote speeches for today's purposes, I would also like to thank the panelists and the moderators. I guess that in terms of concluding remarks, we see some basic trends. There is a clear willingness to keep on engaging with each other. And I think that from what we heard also from issuers, but also from asset owners and asset managers, together with the signatory parties themselves, the service providers, the BPP OC is fulfilling its mission. It is engaging with both service providers and with different stakeholders, always in order to fulfill its ultimate mission and purpose, which is education, dispelling myths, but also, and most importantly, ensuring credibility of the monitored self-regulation system. And I'm mentioning the credibility of the monitored self-regulation system because, of course, as I have written elsewhere, regulators keep on watching what we're doing. And of course, we are delighted that this is the case. But of course, it is up to us to fulfill our mission, to demonstrate to the world that the ongoing engagement with service providers is a fruitful one, but we also on the fact that we deliver results. And we were delighted to also get this very positive assessment and endorsement from the FRC today, acknowledging the fact that we keep on working very, very hard with service providers in order to keep on improving disclosure statements. And I was also particularly pleased that once again this year, together with Tilba and the rest of the BPP OC, we were pleasantly in a position to confirm that not only do signatory parties, not only do they follow our recommendations, but they actually meaningfully act upon them in order to keep on ensuring meaningful compliance to their own code of conduct. So disclosure statements keep on being improved, transparency keeps on being improved, and as far as we keep on working upon that kind of productive relationship, I think that the future of monitored self-regulation is bright. I would like to thank all of you, and again, of course, the Corporate and Financial Law Group at the University of Glasgow for co-hosting this event, and also Glass Lewis and Minerva for providing admin support, and of course to Jen Thompson from Glass Lewis for all her precious help in bringing together the BPP OC annual report that you can find on our website, together with the annual signatory statements, and of course, any media releases that the BPP OC and the BPPG put up online. I would like to remind you that this forum, as it is the case every year, it is recorded and we will be offering it freely to our stakeholders on YouTube in a few days. So watch this space. I will be sharing a link with all of you a little bit later this period. Thank you very much for your participation. We all look forward to welcoming you to the 5th BPP OC Annual Forum in 2025. More information on that in a few months down the line. Thank you. Have a nice evening.